All right, well, welcome everybody to our AMA, our live AMA here at Global X Canada. My name is Alex Smahtin. I'm a portfolio manager and senior analyst here at Global X.
I'm Brooke Thackeray, research analyst at Global X. And I just want to say that anything we talk about today is not financial advice. It's for educational purposes only.
Absolutely. So just to kick things off, we had asked you a poll just to get things started. So the poll was, well, which of the following do you think has the most upside heading into 2026? Is that gold, silver, uranium, or copper? The results?
And the results are 40% for gold, 20% for silver, 20% for uranium, and 20% for copper. So gold is the official winner. Everything else is tied.
What do you think, Brooke? Do you think it's gold or silver or
You know,
copper,
I think in the end, I think it is gold.
Yeah.
I think all of those commodities have a strong chance of moving higher, but I think right now gold's on a little bit of a pause here. We saw it have a record high week after week. We saw gold move higher and higher, became extremely overbought. We have seen a pullback from that 4,300. We saw it pull back here, and that's natural. Things aren't going to move up forever on a straight line basis, so maybe we do see a little bit of a consolidation at this point.
A little bit of plateau and then
I think so.
maybe
That's a pattern
26.
we've seen with gold over the last few years. We've seen consolidation, rally. But in those consolidations, it goes up and down, up and down. So maybe we're in one of those down moments right now for gold. But I think in 2026, going and looking forward, I think we'll be breaking out of this consolidation and moving to an all-time high once again.
Great. Yeah, I think I'm in the same boat, honestly. With that said, how about we jump into some questions?
Sure, yeah.
So the first question we've got here is from Craig Hoxton. Everyone's focus has been on tech and AI. Are investors missing out on other sectors? Beyond that, all these data centers need power, so should we be also looking at nuclear or uranium power? And is there any other sector that we've been ignoring but is worthy of an investigation?
Yeah, so what we're seeing is AI in the tech sector. I mean, they're good sectors, of course, but they're sucking the oxygen right out of everything, from the media, from the narrative, et cetera. But the one part of the market that's really not getting as much attention as what I think should be given is the uranium sector. I mean, it's there. It's a great sector. We know everything about uranium. We know the long-term demand. We know the long-term supply. We know there's a deficit. It's just a matter of when that deficit occurs, and we know the demand's going to be increasing. So fundamentally, it's in great shape. So I think once the emphasis comes off of some of the tech stocks and the AI sector, I think uranium will actually benefit as well.
I think so too. Like we've got our funds at Global X where we take a look at AI and AI infrastructure, and a big part of those conversations that we've had with clients has always been about. Really about that, proliferation of nuclear power as being a solution for that energy demand. That electrification that has to occur to support all of this capex ends up having to kind of go somewhere. And nuclear power just seems to be like a very natural destination for it. Even if it's not there yet, we know that demand is ramping up very significantly. We're seeing, across the globe, investments being put into the space.
Well, look, earlier this week, 2 days ago, or yesterday, we saw that announcement with Cameco and Brookfield come out. $80 billion in the U.S. that they're going to be committing from the government level to build nuclear reactors across the USA. And this is a fantastic opportunity. So we saw Cameco respond really well, but we saw all the other nuclear stocks go up at the same time. They benefited from that. And I think we're going to see more of this. Now, it's going to take a while before nuclear power comes online. You just don't build these on a 100% yearly basis. But I do think longer term, there's the commitment to bring on more and more nuclear power stations.
Absolutely. Just then to wrap that same question up, though, is there another sector, do you think, that has been ignored but is worthy of investigation? Or do you think that nuclear power is that sector?
And nuclear power is that sector.
Okay,
I really believe that. I just don't think there's enough emphasis there yet. And I think we're going to see more announcements like what we saw yesterday with the Cameco and Brookfield and the U.S. government. We're going to see more announcements being made in that sector, both in the U.S. and Canada as well. So
for sure.
Definitely a sector to be looking at.
Absolutely. I completely agree. So then, just moving on to the next question, we got another question from Craig Hoxton. How did you get started in this field? What advice do you have for people who might want to build a career in investments and finance? I might just kick this one off.
Sure. Yeah, go ahead.
I've got a shorter career. So I started out by just going to school for finance and economics at the University of Toronto. From there, I got into operations at a large bank, and then went to another bank from there, more in ETFs, in a more ETF-specific role. And then I came to Global X, where I've been since, now in a portfolio manager capacity. As far as advice goes, I think your advice is going to be much better than any of mine. I think at the end of the day, it's important to, beyond just being good at your job, I think that you also want to be, I think this applies beyond finance and investments really, is that you kind of want to be personable as well. It just makes it easier to both be in the workplace and just like make connections and so on from there. I know that's kind of ambiguous as far as like investments and finance goes, but I don't know, that's been my biggest learning, at least in my career so far.
Yeah, so how I started out from an education standpoint, I did my undergrad in economics and went on to do my MBA at Schulich for economics and finance. And love what I saw, and I had a real interest in the stock market. For me, it's always something that I was looking at, and I think that's important. If you really want to get involved in this industry, you have to be personally interested in it, and it's not just, hey, I want to be there. It's a cool job, but you have to be personally interested.
Absolutely.
So I started on the sell side, actually.
Oh, nice.
With the TD operation way back when, and in different various roles in different companies over time. And I've been working with now Global X, for over 16 years, actually, with the Global X Seasonal Rotation ETF, ticker symbol HAC.
It's a great fund. So then, I hope that answers that question. We can move on to the next one. We've got one from Deep Doctor 7180. What could the rise in gold prices mean for markets?
Well, I think the way to look at this is that the gold prices are saying something. And I think investors are worried about what's taking place in the economies. You're seeing governments spend a lot of money, and they're committing to spending more and more money. Investors are thinking, whoa, this is part of the debasement trade. So we're seeing that phrase come up a lot more now.
Absolutely, yeah, for sure.
And that's a long-term concern, that you're seeing central banks that are lowering interest rates, and we saw that with the Bank of Canada this morning, and we're probably going to see that with the Federal Reserve this afternoon as well. And governments continue to spend money, so investors are saying, well, where do I go? If interest rates are going to be moving up on the long end of the curve, which has been happening in Japan, France, the UK, the US, and even Canada, do I really want to be invested so much in bonds? And we're seeing people like Jamie Dimon at JP Morgan come out and say, well, you know what? Maybe you should have not so much invested in the bonds long term and maybe an allocation to gold. So I think that's part of what's taking place. So I think gold is really the signal that's taking place,
for sure,
more than the cause of what's happening.
We're also seeing, to my knowledge, a significant amount of investment just moving towards just gold, really. Like that's just becoming such an increase, to your point, is becoming such an increasing allocation in investors' portfolios, more so than it has been in the past. And that's we've got a chart for this in terms of just the amount of gold buying that millennials might be doing. But besides that, I think there's a great chart that I just don't have at the tip of my tongue, but where you can actually see the increase in gold buying from central banks, but then you can see the increase in demand from ETFs and other funds in gold as a 43. With the recent drop in silver and gold, do you see fundamentals like interest rate expectations or investor sentiment supporting a rebound? Or could we see extended weakness in precious metals?
So gold's a funny instrument because it trades off different things at different times. And successful decision 43 mentioned about interest rate expectations on a go-forward basis, or even inflation and investor sentiment. So it does trade off these things at different times. But what's really moving gold is what we talked about earlier on. A couple of things. First of all is that central banks are buying it.
Yep.
And we've seen that relationship with interest rates, because typically you'd find that gold would have a high correlation to real interest rates. And that's actually broken down, where gold has continued to move up, and where real interest rates have stayed steady here. So that's part of it. I think what's really driving gold now is not some of the metrics that we looked at in the past. Because when you're buying gold, in the past, investors would say, what's happening with interest rates? If interest rates are going up, then the gold shouldn't do so well. That's not the case here today. No. We're seeing interest rates, even when they go up, gold's performing well. I think it really is that debasement trade that's really influencing what's taking place, and central bank buying.
Yeah, that the central bank buying really cannot be understated. It's remarkable how big of a difference it's made, especially just in the way that the general sentiment around gold as an investment comes in a portfolio.
It's all central banks, by the way. Non-Western central banks are really the ones that are buying gold this time. And here's an interesting tidbit: the Bank of Canada has zero gold.
That is
in their reserves. Yeah, we sold our last piece of gold in 2016. So we're seeing banks ramp up their gold purchase around the world, but not Canada.
Interesting.
Yeah.
All right. Well, then with that, we can. We'd also like to have a quick reminder here that none of what we've said here is financial advice. But we'll just say that real quick before we move into the next question from Typical Fix 8569. If you could pick only one metal for 2026, gold or silver or copper, which one would you choose? So we kind of covered this earlier, a little bit at the start. So we both went a little bit towards gold, we think, right? It like plateaus maybe for now, and then maybe continues, or so that consolidation happens, and then it continues in 2026. That'd be kind of the
yeah. So I mean, copper's being driven by something totally different, right?
It's not an apples to apples comparison. That one's more industrial in nature, so that one's really almost like a bet on where we think the broader economy might be in 2026.
And that's also being affected by the tariffs. So there's been front running the tariffs. So it gets a little murky, but we have seen copper do extremely well recently. It's reaching some fairly decent levels here. Between silver and gold, silver's done extremely well.
Absolutely.
Because it really lagged gold, and it's benefiting from the echo of what's taking place.
For sure, it's like a piggyback trade almost, because of that gold to silver ratio that folks focus on a fair bit. So
and we saw that really get out of whack, where gold to silver ratio is up to around 100 at one point, and then investors go, whoa, and we find that when it gets up to around 100, that investors will say, now silver's become really, really undervalued relative to gold. Absolutely. And so we've seen it move back down. So silver's done extremely well in that context. I think silver can still do well next year, but I think probably the longer term perspective, I would say central banks are still buying gold. They're not buying silver.
It's true.
Right?
Yeah.
So I would say that gold has less volatility typically than silver as well.
I agree, yeah. I'm in the same boat. I think, like we said earlier, I think gold is probably the one I'd have to pick for 2026 for all the reasons we've discussed here. So with that, I think we can move on to the next question.
Sure, yeah.
From Gullible Orange 9449, can you hold leveraged covered call ETFs in the medium to long term? So happy to kick things off here on this one.
Yeah.
So here at Global X, we offer a variety of covered call and levered covered call ETFs. When it comes to holding leveraged covered call ETFs, typically we're talking about, call it mild leverage, which is something to the tune of 25%. And so in those cases, when it comes to covered call products, really we kind of view them as income products. And so a covered call will essentially just amplify the experience of a regular covered call. But it amplifies largely everything, in that it amplifies the yield, but also with that you take on more risk when you're holding one of those products. You introduce path dependency in terms of how that leverage might be reset and how the underlying moves. And so it's ultimately one of those things where, yes, you can hold them medium to long term, but you do have to be cognizant of the fact that you are opening yourself up to, potentially larger drawdowns. But at the same time, that's something that many investors are comfortable doing because at the same time they're earning higher premiums and generally participating in more of the upside of the underlying than they would in, say, a vanilla covered call.
Yeah, I think everything has to be looked at in the context of the other holdings in a portfolio as well,
Absolutely.
and what your objectives are and your risk tolerances as well. It is one tool that can be used.
For sure. So then we can
Sure.
move on to the next question
Yeah.
with that then. So from Compote 6817, what's one mistake you think new investors make when it comes to chasing trends like these?
Well, I think
Good question.
it's emotion. I think that
Emotion, yeah.
it would be the biggest factor that new investors have to deal with, because they go, I really like this trade, whether it's AI
Right.
or gold or whatever it is, and they make one individual bet or place the trade on one sector like that, and they go, okay. And it's not always going to work out right away, and so perhaps they can actually hurt themselves. Because all of a sudden it goes down, they go, okay, I don't want any more to do with this. And I think the best way is to have sure, you can overweight uranium or gold, and that's always part of that. But I think you have to have a bigger picture as well. I think that's the most important thing for our new investors, is to follow a disciplined strategy and have a portfolio that makes sense, not just based upon one or two aspects of the market at the same time. And realize that not every trade's going to work for anybody, so you have to be able to follow through with the right amounts in the trade without risking too much in one trade.
Absolutely. Another thing that I just like to flag, and I talk about this with friends and family, this is not financial advice, but when it comes to investing, a strategy that many find that it gives them some comfort is just dollar cost averaging as well, in the sense that if you're not going to make instead of making one big bet at one point in time, you
yeah, you know what, I agree with you. And so the fund I work with, we actually will dollar cost average into positions as well. We'll take tranches. The problem some investors have with that is they'll make that first tranche, the first stage, and all of a sudden the investment will go down. They'll go, whoa,
yeah, exactly.
You know what? And they go, hey, you know what? It's gone down in price. Maybe it's going to go. Maybe it's going to go lower. And so they're not committed to that second piece. So very often they'll fall short of making those dollar cost averaging.
Yep.
So I think if you're going to do that strategy, and I think it's a great idea, is you have to actually set your parameters up and follow through with it, rather than once again, it's emotion that gets in the way.
Yeah, absolutely. It's a behavioral thing. It's like it's really hard to, especially in if you've been dollar cost averaging, let's say the entire bull run, and then it sells off, you don't really feel comfortable buying on the way down,
right.
But that's the whole premise of a dollar cost average strategy, is that you are buying on the way down, and as a result, because you're using the same dollar value, you end up actually reducing your cost base. So that ends up being, so long as you have the strategy in place and you're actually following through with it and not taken out by the emotion.
And even if it goes up, it means you bought everything cheaper before. So you're doing a weighted average, basically, is what you have to subscribe to.
But yeah, just a thought in any case. With that, we can move on to the next question here from Deep Doctor 7180. Do these metals still make sense if inflation cools off a bit? I think this is a great question for you.
Yeah, so a lot of times the old focus for gold and silver, so I imagine that's really what this is focused on.
I think so as well, yeah.
Was driven, a lot of people would look at inflation and go, this is really an inflation protection hedge. But if you go back and take a look at gold and its price movements in different environments, it can actually do well in other environments, not just inflation going up. So when the Fed's cutting rates, it tends to be supportive of gold prices. And when the Fed's cutting rates, they're doing that because inflation's coming down. Typically, that's where we are right now. So I wouldn't just say that gold is going to trade off inflation expectations, because inflation expectations have actually been holding in pretty level at this place. In Canada, the inflation expectations right now are at around 2%. In the States, it's probably around the same as well. So I wouldn't use that as a metric. In fact, if we do see, even if we go into a disinflationary period, gold can still perform well, because what would happen is the expectation would be that the Federal Reserve and the Bank of Canada would come out and create a lot of stimulus, and when they're creating more money into the economy, they're making the money that is currently out there worth less. which means that something like gold, a hard asset, would be worth more. So inflation is not the best metric, I think, to be looking at as far as, hey, should be buying more or less gold.
Yeah, not in a vacuum, right? Because at the end of the day, like a big portion also of that gold demand is also that uncertainty trade. It's a very natural safe haven, especially now that the debasement conversation is becoming more commonplace. It's like, where do you really put your money if you're not sure and you're not comfortable putting it into equities even? You just naturally tend towards gold. And even if inflation cools, there's still a variety of uncertainties out there in our current market. So it's really difficult for us to say that gold, just inflation cooling alone will be, is just one way to look at it. You know what I mean? Yeah.
Absolutely.
With that said, we can move on to the next question here from questions about cash. For someone who doesn't follow commodities every day, how should we even think about adding them to a portfolio?
Yeah, that's a tough one because the focus has been on so much of other parts of the market. And probably the best way to do that, there's different ways to invest in commodities. You could buy into the futures market yourself, which would be extremely time demanding, sophisticated, and that's probably not the best way for most
the
investors.
Market will spook you.
Yeah, exactly. And so probably the best way is to use some sort of ETF. So you can invest in the commodities themselves, but you can also invest in the companies that are perhaps mining the commodities or distributing the commodities. So there's different ways to do this. And I think the best approach is to use ETFs overall. And so we find a number of ETFs that are really focused on the commodities themselves. So they'll actually do that for you and say, hey, let's try and replicate the price movement of copper as much as possible so you can take advantage of that, or gold itself as well at the same time. So ETFs, I think, are the best avenue to express that viewpoint with commodities. And I don't see that changing. I think that's, particularly with commodities, I think that's a better way to go, even more so compared to stocks.
I agree, absolutely. I think this is a great opportunity for us to just sort of even break down for potential viewers and anybody asking the question, the differences in those ETFs as well. So we've got, the futures-based ETFs. But then we've got those that, in the case of gold, for example, will hold the gold bullion itself. And then also, to your point, you could be investing in an ETF that invests in the companies that mine these commodities potentially. So just to break those down, ultimately, if you're holding an ETF that tracks the futures, then there's contango often involved. What that means is that's just the cost of rolling the futures position because those contracts will expire and they need to be replaced. That's if. And contango can be a cost, but potentially if there's backwardation, then it could be a benefit to the fund performance. If it's holding the physical bullion itself, then that is as close to a true exposure as I think you could possibly ask for when it comes to an ETF. And then when it comes to the miners or the producers of these commodities, then in that case you do take on idiosyncratic risk from the perspective of the equities themselves or the companies themselves, but you also do get some operational leverage involved there as well. It costs, there's high fixed costs associated with like setting up a gold mine, for example. And so if the gold price, goes up high, stays high, then gold producers can continue potentially to do well. And to that point, we've seen gold producers, for example, this year really go on a very impressive run. Similarly, come down pretty aggressively on the gold sell-off, but nonetheless, there's that operational leverage element there as well.
And to help remove some of that risk, I think the best way actually in this commodity space is an ETF once again. So
for sure,
a good example would be, for instance, Global X Canada has the uranium ETF, ticker symbol HURA, that trades on Toronto. And so it's got Cameco, as an example, as part of the portfolio, which benefited from that Brookfield announcement yesterday. It's also got Denison Mines. It's also got NextGen. So some of the smaller, NextGen would be a smaller company in that space. At the same time, it also holds the Sprott physical product.
Absolutely, yeah.
Around 15% of the portfolio. So you're getting this really diversified approach. So you're not going to worry so much about the idiosyncratic risk or the headline risk for any individual company, because that can work on the downside as well.
Absolutely. And that's why it's important to peek under the hood of every ETF that you're thinking about investing in. With that said, I think we can move on to the next question here. Pardon me, don't see the name there, but that's right. What is driving the renewed interest in silver this year?
I think it's because everybody looked at it and said, well, gold's gone up so much and silver wasn't moving. Typically gold moves first, and then you find silver moving and then gold miners. And that's exactly what we've seen. So this has actually followed what we normally see in a cycle as well. So as we said earlier on, that gold-silver ratio, everybody said, well, gold to silver, trading at 100 to 1, so 1 ounce of gold costing 100 times more than 1 ounce of silver. They said, "Whoa, that's way too much,"
right.
And so they stepped into silver as well. So I think that's been probably the biggest factor here.
I think so too. I think it's in general the metals have had I suppose specifically gold and silver, but silver as a consequence of gold's rally, just people are naturally looking for, if they might have missed out on the gold trade, they might think, well, maybe I can get in on some of that piggyback, if you will.
Because it represented good value, and they said, hey, you know what, this is undervalued.
Exactly.
And it's like, it's the poor man's gold. And sometimes they'll think about, well, you know what, I know we can buy in shares or small amounts, but some people still look at it and go, you know what, this is just cheaper. So it has more potential. It's not necessarily true, it's on a percentage basis, but that's what happens.
For sure. And to that point, actually, even with gold, because we've been talking about all the central bank buying, right, that provides a bit of a floor also to gold. So even when we were talking about it being overbought, there's a fair amount of discourse that we've seen where, folks think, it's overbought, but it's still supportive of a more longer-term structural move.
It'd be really interesting if we start to see central banks actually buy silver. Okay? Now, believe it or not.
We're seeing India, actually. They instituted that new rule. I'm going to have to remember to go back to what the rule was, but I think that they're taking on domestic silver on a very favorable ratio to gold as well.
Oh, okay, interesting. I mean, central banks used to have some silver as well. I mean, right now it's the focus on gold, but just like investors, they might actually start increasing or start partaking in the silver investments. So we'd have to see, because that would really all of a sudden put a fire under silver as well. And it's a narrow market. So the one thing I will say here is silver and gold is very narrowly owned in Western portfolios. If you take a look at on an institutional basis, it's people estimate around 1% in a portfolio, maybe 2% now. It depends on which estimates you're looking at. Traditionally, sometimes it's been up to 5 to 10% in an institutional portfolio.
Getting closer to that?
I think if we start to move that number up, because right now gold is actually a fairly small market. Silver, the same thing, obviously, but gold is a $27 trillion asset. But if you start to see institutions actually increasing their percentage in gold and silver, it's a narrow door, and that could actually increase it. Interestingly enough, they haven't been doing that. So despite what's happened with gold, we talked about the central banks being interested in really helping to push up price, and some of the retail investors. But the retail investors in Asian countries are really excited about this and pushing this up. Not so much in North America. The focus has been on the tech sector.
Yeah, I hear you. With that in mind, we can move on to the next question from Curious Avocado 72. What might be accounting for the draw to fixed income strategies we're currently seeing among young investors?
Do you want to do this one?
Yeah, you know what, I think I might. So as a young investor myself, I think that a natural question that comes up right now in a time like this, when we have a ton of tech investments, is, did I miss the boat? Like, do you necessarily, like a lot of investors, especially those that are early on in their careers, they finally have some cash that they can allocate to their investments and their portfolios. It might be difficult for them to actually, feel comfortable buying into the AI cycle at this stage. Mm-hmm. They might. A lot of folks actually, I know even anecdotally, are just sitting on the sidelines waiting for it to pull back. With the idea being that they can buy the dip, and that buy the dip mentality is pretty common now. I feel like that whenever we do have a pullback, there's the next day's headline is like, oh, the dip buyers came in, and so I do think that what ends up happening instead is that we have this question then. Well, where do I allocate? Mm-hmm. And so gold, natural destination, but then fixed income instruments also, because standard sort of theory suggests it's like, hey, you're not necessarily feeling equities, you go towards fixed income, or at least that's what like folks might be taught, right? And so as a result, what ends up happening is exactly that, is that I think younger investors are looking for just new places to allocate, and fixed income ends up feeling like a very natural destination.
Is it also too perhaps that they want more flexibility in the portfolio, and they think fixed income investments might offer that, so they for their own needs? I'm not sure.
I think so. Like I think there's an element of that. An important thing to also consider is that like even the 10-year and the 30-year on U.S. Treasuries is quite high, right? And so. Like if you just ask like a young investor who might, especially those that might not necessarily feel as comfortable investing in general, and you're like, hey, you can buy into AI, but then, or tech and U.S. equities, but then every headline they see is like, oh, is there a bubble? And then at the same time, you offer U.S. Treasuries, and you say, hey, you can clip like 4% on this,
right?
5%, right? And you wait.
Yeah.
And they're like, yeah, you know what, I can do that because the average on the S&P is 8%. So like I'm not actually kind of over a long-term average, and so I'm not actually losing out that much when I do this. And so I think those kinds of conversations are becoming pretty common. Again, largely anecdotally in my case, but nonetheless, I do think that's sort of like where the mentality might be.
Okay, good.
So we've got a question here from Dryader. Assuming there is an AI bubble and it pops tomorrow, let's say, what defensive or inverse positions out there exist besides the Beta Pro Vol-X ETF? As there was an article out that hedge funds are shorting. Sorry, I'm gonna pardon. Okay. Apologies. Sorry,
They're shorting. Yeah, they're shorting.
We'll have to. So they are shorting. I didn't get to see the end of that question, but ultimately, like, I guess we can still answer it ultimately.
Sure, yeah, of course.
So this is not financial advice, but to that question, let's say the AI bubble pops tomorrow. What are the defensive and inverse positions that come to mind for you?
Well, first of all, I just want to qualify that we can't tell if and when the
no,
bubble's
absolutely, 100%.
So I just want to say that up front.
Not financial advice. We are not making predictions that's going to pop tomorrow.
And even then, if we go back to the tech bubble in 1999, 2000, it sort of burst, but it didn't, like, it wasn't one day and it kept going down. It was a lot of up and down. So it's very difficult to tell when it actually is bursting. It's not like one day per se in that case.
And also in what capacity, right?
Yes.
Because especially now with all of these like commingled investments across the AI companies and just the proliferation of these partnerships, it's really hard to say how that would play out at all. But let's say, like market corrects tomorrow significantly. Like what's the inverse, or what are the positions do you think that come to mind for you?
So I think before people, it all depends on the portfolios they have and if they want to maintain their equity positions and whatnot. It's a risky move to all of a sudden now say, hey, I'm going to, let's say, get out of the market per se because the tech bubble burst yesterday, and it could have just been a temporary correction.
It's true.
This is exactly what happens, close to the top too, and then it rallies back up 30%, and you go, well, why did I get out?
Yeah,
right?
You missed out.
And sometimes you think we're at the top, but we're really further down. We can see a lot of volatility taking place. So, I mean, one of the aspects might be to raise cash if you thought that perhaps there was a tech bubble bursting. But, the next step would be to go to some sort of inverse position on in either the NASDAQ or the S&P 500. You could actually in your portfolio with that. But the danger with that is you have to really follow that very closely and make sure that you actually have stops in place as well. I mean, you should always be following your positions and taking a look and see if they're working or not, because you can be right and wrong. And what I mean by that is, maybe it is going down, and then it gets whipsawed. All of a sudden, despite it bursting, it goes up by 30%, and you go, okay, it didn't burst, right? And then it comes back down again. So there are inverse ETFs that are there for that purpose as well. And you can help to hedge your portfolio for that. So let's say you want to maintain your positions in, let's say, your tech stocks or whatever it is, or in the S&P 500, you could actually take a position in an inverse ETF. In the shorter time period, it's not something that I would say is appropriate to hold over the longer time frame. But if we are in that phase where you do believe we're seeing a big drawdown take place, that's one way of hedging a portfolio.
I think it really just echoes sort of the initial positioning you brought forward. I think that at the end of the day, really it boils down to, again, not financial advice, but this isn't really about timing the top. It's really about just maintaining a consistent portfolio construction strategy, knowing what your positions are, monitoring them, being comfortable with the positions that you have, and also, knowing what your limits are, knowing where your exits are, and following through with your strategy with the least amount of just pure emotion involved as possible. At the end of the day, like staying invested is a common theme. But staying invested also suggests that you have to be able to fight the emotion of wanting to sell into a sell-off. And ultimately, it really boils down to your point, the way that your portfolio is constructed and the way that you intend to be invested in the market, let's say at near tops, on drawdowns, or even in a plateau or what have you. It really boils down to just making sure that your portfolio is constructed in a way that you can make those tilts without necessarily needing to go all in on like an inverse ETF just to protect yourself.
Absolutely.
So with that, I think we have one more question here, sorry. What risks should investors keep in mind when using covered call strategies? Great question and super topical for us here at Global X with all of our covered call strategies. At the end of the day, just to give a high-level overview of what a covered call strategy really is, what we're really doing is we're selling call options on our underlying equity position. And in doing so, we generate a tax-efficient yield or dividend that we pay out then to investors. The trade-off, and on top of that, by doing so, we also reduce a little bit of the volatility of the underlying as well. The ultimate trade-off that you take on as an investor in a strategy like this is some of that upside, because that's ultimately how we generate that yield, is we have to trade some of the upside that you might experience on the underlying in order to generate that tax.
And I find a lot of investors actually forget that actually takes place because they'll actually say, hey, how come this ETF didn't, when let's say the Canadian banks are going up, straight up, they're going, how come it didn't do as well as that ETF that wasn't using covered calls,
right?
And that's because it's designed differently, basically.
Exactly.
And they have forgotten that.
Yeah. And so it's important to remember what that trade-off is, but that's ultimately, arguably, the one that I think investors forget the most. Besides that, it is still, especially if it's an equity covered call, it is still an equity investment, and so it's not by any means risk-free. And when we say that we're reducing some volatility, it means that you still participate on the downside. You're not exempt or protected on the downside. Besides the premium that you've earned on the options. And so that's another just thing to keep in mind, is that we're not protecting the downside entirely in the strategy, but rather we're giving you a little bit of a buffer on the way down, a small one just based off of the yield that we generate. So just remembering that it's still an equity investment and that you trade upside for yield, and those are the big ones I think that we come back to with investors for sure. And so with all of that in mind, I'm not sure if we have any more questions to cover here. Oh, sorry, we have one more. That is, what opportunities do you see in commodities as we head into 2026? So we've talked about gold, we've talked about silver, we've touched on copper, and
what about energy? Let's talk about energy.
Sure, yeah, let's do it. So we haven't talked about, we talked a little bit about uranium.
Yeah, but oil and gas.
Oil and gas. What are your thoughts?
Well, first of all, I think we're seeing this demand pick up for the gas sector.
Absolutely,
natural gas.
100%, yeah, for sure.
In fact, we had a chart. We have a chart number 2, that shows that over the next number of years, the data centers are going to have to get a lot of power, and where that power is coming from. So we love nuclear, right?
Yep.
But nuclear is not going to do that over the next 10 years.
Advice.
Not financial advice. Yeah, and you can see that actually it's gas, natural gas is one of the major components for that supply of power for the data centers. And that's why we saw Meta make an announcement with Pembina Pipelines to build a data center facility just outside of Edmonton. Because they go, well, we need this power and this energy for AI, and so natural gas, I think, is that transition. And so we're going to see a lot more talk about that. In Canada now, we've opened up an export terminal on the West Coast recently, which is definitely going to give us a boost. We're going to see more of that. And the real focus, I think, is going to be on natural gas. So I think longer term, natural gas is really going to come back into play here. And I think even oil itself, Definitely the EIA in the States has come out and said, hey, we're actually bumping up our oil demand forecast for the number of years because we're finding that the transition is going to take longer. So despite everybody moving towards green and all that, we're finding that the demand still is there in the transition. So I think the energy sector in 2026 could actually do quite well. The caveat I would say would be that if we find that the economy slowed down substantially, we went into a recession, I think the oil sector would actually get hit. But right now, it's really the price of oil. West Texas Intermediate crude is trading at $58 to $62, back and forth in that range. So if we don't slip into a recession, and the economies pick up, I think we can actually see the oil companies actually do quite well.
Just of more like a technical discussion, I've heard some chatter about potentially, especially as gold kind of plateaus or perhaps just kind of sits into this sort of like back and forth range. Do you think some investment will move, or just naturally from like institutional buyers or someone else would move from gold into just staying within their commodity sleeve? They kind of move towards oil instead, perhaps?
I think there might be a little bit of that. But if we take a look, there's an article just put up by Bloomberg, and they talked about previous Federal Reserve cuts and how gold has performed around those cuts.
Right.
So we just saw the Federal Reserve, today they're probably going to be making their second cut as well in a row from September. Before that, there was a long pause. So it's really considered a new type of cut. And they've gone back and analyzed, and what you see is gold tends to rally into when the Federal Reserve cuts rates until shortly after. And then for about 3 months or so, you find gold pulling back in price, on average. It doesn't happen all the time.
Right.
And so we're in that phase. So I don't think we're going to see this all of a sudden. We might see consolidation for gold price, but I don't think it's consistent. I don't think it's going to be like a 6 month or a year type of phase. So I don't think we're going to see a lot of investors leave the gold space. I think the hot money's come out, because there's hot money chasing it. I think that's already happened. But so I do see perhaps gold come back. So I don't think there's going to be a lot of exodus from gold to energy. I think in general, investors, I think, are going to come back into the sector just if we see economic strength.
Right, yeah, absolutely agree. And then we got another question here from FigScary6343. Are there any commodities specifically impacted in the short term by today's Bank of Canada rate drop? And will U.S. Fed rate this afternoon have any impact on these same commodities?
Yeah, so in the context, the Bank of Canada, it doesn't matter that much. It's more the Federal Reserve that's going to matter. And honestly, it's not even the Federal Reserve. And the reason being, it's more about interest rates than anything else that in the short term has the sensitivity with commodities. And it really surprised everybody last year when the Federal Reserve started to cut rates. And all of a sudden, the 10-year interest rate went up, and they went, what? Why did that happen? And so the Federal Reserve controls that short part of the curve. So like 2-year government bonds are probably the best indicator for that, but the 10-year yield, not so much. So I don't think the Federal Reserve cutting rates today is going to have an impact on commodities per se. I think it's more important to follow what's happening with the 10-year yield, although it might, in the longer term. So it may have a small impact, but nothing that I think would have hey, I've got to change the strategy here at all.
Also, to that point, a lot of the action that might have happened going into today's cut has, I think, largely already been somewhat priced in to some degree. I think the expectation is that with near certainty that they're going to cut. I mean, there's still a non-zero chance that they might not, but the idea is that when there's so much certainty in the market, the big shakeups happen when the market is surprised. If they cut, and the conversation from Jerome Powell is pretty straightforward, then there might not be any particular surprises. Yeah, so the Bank of Canada cut today, so now we're down to 2.25 on their overnight rate. And here's the interesting part. I actually just looked it up before we came in here, and that is if you take a look at the overnight interest swaps market, looks at the probability of the Bank of Canada cutting rates further for the next year. Nothing. Yeah. 0 cuts. Yeah. Okay. So investors don't really see this right now. They go, oh, the Bank of Canada is going to keep cutting. But right now, the markets are not expecting that to happen. Yeah. And this compares to the Federal Reserve, which is expecting 4 cuts over the next year. So they're expecting to cut today, and then they're expecting also to cut in December with a fairly high probability as well. Right. So we may see some more cuts in the U.S. as expected, but the Bank of Canada, I find, is interesting.
they don't have that much to go. When you're at 2.25%, what are you going to take it down to 1% or
Not
lower?
totally.
It's going to be very, very difficult.
And Tiff Macklem even spoke to it. He was talking about how a lot of the uncertainty, there's still a variety of ways that the economy could play out, but for the most part, a lot of the uncertainty that they had earlier in the year has already kind of shaken out a little bit, and so it's a little bit easier for them to, with confidence, say, we're probably going to stay here for now, or at least consider staying here for a while. So we've got another question here. How could ongoing tariff tensions impact commodities like copper and uranium? That's a good question.
Well, I think what we're probably going to see, if we do see tariffs right now on the U.S., copper and uranium going into the States. Copper, it's at 50%. Uranium, it was at 10%. I'm not sure. It's changed so much at one time. Maybe it's a strategic metal and it's been taken off. But I think ultimately my viewpoint on this is that there's a lot of emotion going back and forth, and I'm not going to get political here on both sides of the border, but ultimately, if you take a look at the tariffs on Canada, and let's say compare that to the tariffs from the U.S. on the rest of the world, it's a very different situation. The reason being is we're supplying the inputs for a lot of the U.S. products. So we're not really shipping finished product to the States. They need our copper at a good price. We're one of their major importers for copper. They only produce 45% of the domestic copper, and they have to import the rest. Chile is just slightly ahead of Canada. We actually support a huge amount of copper. So if they put tariffs on copper, that's going to drive up the prices of their output products, and they know that. So ultimately, I think we're in a different situation than other countries. I think down the road, somehow we'll see these tariffs actually definitely on these products that will actually be much, much, much reduced from where they are.
Yeah, absolutely. I think that we're talking about inputs here that are just too crucial to the overall, call it overall supply chain of the U.S. economy and even of our own. And so I think that these ones will definitely have a different discussion than maybe other sections of Canadian exports to the U.S. So I think that about wraps it up. Actually, that's all the questions that we have here today. Thank you for your time, Brooke.
Well, thank you. It's been a lot of fun and great conversations.
Yeah, absolutely. And then my name's Alex. This is Brooke, and